Today, I have an information-packed video for you. We're going to be talking about 7 ways you or a financial professional can help improve your investment portfolio. Many investors feel like there's only so much that you can do on the investment front. Invest in index funds and let the market do the heavy lifting. However, I've got 7 ideas that are going to go beyond just buy and hold and be additive on top of what you're already doing. Number 1, make sure your cash is always invested in the best spot. Not all cash is created equal. For instance, with many custodians, if you leave uninvested funds just sitting in the default bank sweep account, often you will be earning somewhere from 0.05% to as high as maybe 0.25%. Now, the benefit of this type of cash is you can withdraw it immediately. However, if you don't need the money today, there are often better cash options like money market funds. As you can see right now, if your money is at Schwab, there is an over 4% per year benefit of using a money market fund over just leaving that money uninvested. Now, it will only take a day or so to sell out of that money market if you need it. So for really any cash beyond this time horizon, this is really a no-brainer. Now, here's where most people stop their cash search, just simply taking the highest yielding money market fund. However, I urge you to go one step beyond this. There are certain money market funds that can offer certain retirees an added tax advantage. For instance, on the screen I have a U.S. Treasury money market fund. The unique quality of this fund is that the interest will not be taxable at the state level because it's Treasury bond interest. So say you hold cash in a taxable account and are paying a 5% state tax rate. Well, if you hold a regular money market fund with the assumptions on the screen, your after-tax return is really below 4%. Whereas the Treasury fund return shows an interest rate above 4%. There are also muni money market funds that are tax exempt on the federal level as well. So make sure you're reviewing all of your options. Number 2, asset location. The financial industry loves to talk about asset allocation, which is what you hold. Asset location is not what you hold, but where you hold those assets. Let's go through an example. Say we have a retiree with a $1.35 million portfolio split between a traditional IRA and a Roth IRA. They're investing in a classic 60-40 stock bond portfolio. Now, how do most investors asset locate their portfolio? They locate equally between both accounts, which seems to make some sense on the surface. If we are a 60-40, we want to be a 60-40 in each account, right? Well, let's think about this a little bit deeper. With a traditional IRA, we are eventually going to owe taxes on the money we withdraw from this account. We're going to be subject to RMDs, where we will be forced to withdraw from this account eventually. With a Roth IRA, the money in this account is tax-free. There are no mandated withdrawals from this account either. In addition, in a lot of cases, we probably have a longer time horizon on those Roth dollars. For most individuals retiring in their 60s, the 60s are a decade where we're trying to do a lot of the heavy lifting tax-wise to keep that traditional IRA in a specific dollar range so RMDs don't crush our situation later in retirement. Often we are doing things like spending down the IRA through withdrawals or even performing things like Roth conversions. In general, we want the safety or bonds located in the account we are going to be withdrawing from. Given this, the asset location strategy should adjust for multiple reasons. It would be wise to put most, if not all, of the stock within the Roth account. Remember, we have a longer time horizon on the withdrawals, and the growth is tax-free. We should then locate the bonds and remaining stock inside of the traditional IRA. Bonds provide the safety for withdrawals and generally grow slower, ultimately slowing the growth of RMDs as well. Now, your underlying return won't change one bit from this adjustment, but your after-tax return will. Shifting more growth into your Roth means that growth will be tax-free. Now, here's an important area to veer off and maybe go on a little bit of a tangent. Throughout all of our videos, having knowledge that a specific strategy exists and is valid is only half of the battle. It's just as important to understand when and if to apply that strategy to your situation. Context is king here. Take something like asset location. Most investors should be following some asset location strategy like the one I just talked about, and also talk about in some of our other videos on this channel. But most is not all. For instance, let's say you retire in your early 60s but need to withdraw from a Roth in order to earn large healthcare subsidies. This would be a situation where you definitely won't want to put all of your stock in that Roth account because if we see a market downturn, you don't have the ability to pull those safe dollars anymore from your Roth. Every strategy is like this. In general, the vast majority of retirees will not want to do big, mega-sized Roth conversions to fix their tax problems. But for some portion of retirees, maybe 2% of retirees, big conversions in a very short time frame will make sense. Knowing your situation and the context around when or when not to apply a given strategy, again, is just as important as knowing the strategy exists in the first place. I think this is a key insight that I often see missed by individuals that maybe a financial professional might be able to help you out with. But moving on, let's talk about number 3, an idea we call relocation. This idea piggybacks on the concept of asset location. Let's add a third account, a taxable account. Now, your taxable account is generally a leaky bucket because dividends and interest are taxed to you on an annual basis. This means dividend and interest is forced income. We don't want forced income in retirement. We want to have the optionality and be able to choose when and where to take that income from to minimize our long-term tax liability. So let's say you have a taxable account that looks just like this. It's very income heavy. All of these positions generate either high interest or high dividends, which again is generally bad in the context of taxes. Ideally, in our asset location strategy, we will want to instead locate some of these positions to either traditional accounts or Roth accounts. This way, we earn the same interest and dividends, but it won't be taxable to us annually. So what is the idea of relocation then? Well, let's take a money market position. It's assumed that you hold this money market for the sake of short-term withdrawals. Often you want to withdraw from a taxable account first throughout your 3 account types because it's such an inefficient account. So how do we balance the issues here? We don't want to hold a money market in our taxable account because of the annual forced income, but we want to withdraw from that taxable account first, which means we want to withdraw money market dollars. This seems to be a contradiction. Well, this is where relocation comes in. Say we move our money market fund into our IRA to fix that annual interest problem. When we need to make withdrawals from our taxable account, here's what we would do with relocation. We go inside of our IRA and we sell $8,000 of money market dollars. All 3 of these steps, by the way, will happen more or less simultaneously. We then go into our taxable account and sell $8,000 of stock. Step 3 then, we go back into stocks within our IRA. What we've done here is we've kept the same stock allocation throughout, but we've lowered our money market position by $8,000. Selling stock within the taxable account generates capital gains, which is generally more tax efficient than otherwise receiving the interest. Now, this is a strategy where, again, context is extremely important. There's a lot we need to manage here, such as wash sale rules. This strategy may not be valid for all retirees, but for those that it is valid for, it can offer a massive benefit. Number 4 is a tedious strategy that many individual investors ignore, but a professional may be able to help with: tax loss harvesting. Tax loss harvesting only applies to a taxable account, and here's how it works. Say at the beginning of the year, Don buys into a Vanguard growth fund in his taxable account. At the time of recording this video, this fund is down about 5% from the initial buy-in price. Tax loss harvesting involves taking an unrealized loss and turning it into a tax gain. Right now, Don's down about $2,750. What he can do right now is sell out of his Vanguard fund and immediately reinvest into a Schwab growth fund. So he sold a Vanguard growth fund to buy a Schwab growth fund, more or less keeping the same internal positions. However, the loss he realized this year, he gets to take against his income, saving about $660 in taxes. Fast forward a year, and let's just say the growth fund has simply recovered the loss but didn't grow any more than that, and Don sells his position. He will have a long-term gain now of $2,750, which he pays a 15% tax on. He avoided income tax rates to later realize that income at lower capital gain rates. Don earned a spread here effectively. Now, in this specific example, Don's added after-tax return was only about 0.5%, but studies have shown that proper ongoing tax loss harvesting can add about 0.75% per year, again, on average. Compound that on an annual basis, and it can be pretty significant over time. But again, tax loss harvesting is quite tedious for the average individual. As you are reinvesting dividends and rebalancing, you will create multiple tranches in each position that you own. Each tranche has its own individual gain or loss, and keeping track of all of these tranches is important to tax loss harvesting effectively, but it does take time. Number 5, rebalancing. Rebalancing is an example of one of the most context-heavy areas of investing. If you look at the academic literature around rebalancing, you will find a lot of non-answers because there's no single best or right strategy. Some papers talk about how scheduled once or twice per year rebalancing can be beneficial in specific scenarios. Other papers show how banded or event-driven rebalancing, like rebalancing when things become extreme, is best. Other papers, like a 2007 paper in the Journal of Financial Planning, question whether rebalancing is even necessary in retirement. Again, there isn't one right answer across the board, but there may be a right answer for you. Depending on which strategy you choose, some rebalancing can reduce risk and volatility. Some rebalancing actually can be quite opportunistic, increasing risk slightly, but also increasing the expected rewards. Let me give you some examples. Say we are invested in that classic 60/40 portfolio, and let's look at a big market crash like 2008. Stocks for the year were down 37% and bonds were up 5%. Because of this performance, at year end, your stock allocation was actually smaller than your bond allocation despite starting out 50% larger. So let's talk through a few rebalancing strategies and their benefits and drawbacks. If you were someone that was most focused on risk and keeping a smoother ride in investing, you might choose to not rebalance at all at this point. In fact, you might only rebalance when stocks are up and that stock allocation has grown more than that starting 60%. Because what happens if you rebalance back to that original 60/40 allocation? You end up adding about $100,000 to stocks right after they dropped almost 40%. Now, in hindsight, we know rebalancing back into stocks was a good thing as a recovery shortly followed 2008. But there was no guarantee that this was going to happen. What happens if stocks fell another 10 to 20% the next year? You added more to stocks only to feel more pain from market losses. Historically, adding to stocks after big losses was a good thing, but it is opportunistic. And so again, what are we trying to do with our rebalancing strategy, and does it fit our plan and goals? Let's talk about a no rebalancing or scheduled rebalancing strategy. What is most likely to happen if we never rebalance in retirement? Assuming an average market, our stock exposure is going to grow throughout retirement as growth positions outperform safety positions, and we obviously consume some of those safety positions. Well, there's a specific strategy we've talked about on this channel before called the reverse glide path. It involves starting with more safety at the onset of retirement, but then you either don't rebalance or rebalance in a way where you add more into stocks over time. Now, this is a counterintuitive strategy, but one that shows some incredibly interesting results. When compared to a more common strategy, like a traditional glide path, what you would find in target date funds, where you add more into safety over time, the reverse glide path wins in every critical category we tested. Further, it also generally wins when compared to strategies where you keep the same allocation consistent, like a 60/40. The reverse glide path offers some of the highest withdrawal rates across the board. Again, depending on your situation, you can achieve a reverse glide path by not rebalancing at all and just simply letting those stock allocations naturally grow as you consume safety, or you can rebalance in a way where you ensure a specific glide path to a specific mix of stocks and bonds. Again, rebalancing can achieve many goals depending on the way you rebalance. So what goal are you trying to achieve? Are you using the right strategy to maximize that goal? Number 6, a personalized allocation will on average beat a generalized allocation. Let me explain this by first walking you through some basic concepts. When we are in retirement, the main reason we need to hold safety is because we are making withdrawals, and we want to withdraw from a stable source, not a volatile source. For instance, would you rather put your money in a portfolio that is expected to grow at 10% per year or 7% per year? This seems like a pretty basic and obvious question. Of course, I'd rather invest in something expected to grow at 10% per year. And depending on where you are in your investing career, that might be the right answer. For instance, in the accumulation phase, two things matter: growth rate and savings rate. The higher these two rates, the more money you will have on average. So when we simulate returns of a high or lower growth portfolio in the accumulation phase, the higher growth portfolio wins the vast majority of the time. But the math and game changes in retirement. Let's think about these two options this way. The higher growth portfolio is an all stock portfolio, and the lower growth portfolio is something like a 60/40. Well, with higher growth, we generally take on more risk and volatility. This volatility can decimate our portfolio in retirement due to sequence of return risk. For example, we still have to pull our retirement dollars out in a 2008 scenario, and by doing so, we are furthering the drawdown we are experiencing in that portfolio. Despite having some incredible simulations where our money grows significantly, a higher growth portfolio results in 18% of simulations failing. Compare this to a lower growth portfolio, and we see only 4% of simulations failing. Now, we don't see the same massive growth in some of the best trials, but our first concern in retirement is generally safety. Our second concern is growth. So the reason I show this example is to drive home the point that safety is important up to the point that we need it for withdrawals. If we don't need withdrawals, we can be a lot more growth focused and take on more risk. The bigger withdrawals we have, generally the more safety we need. Assuming our withdrawal rate isn't crazy high, where we actually need some of the best scenarios in a stock portfolio to make that safe withdrawal rate possible. Or rather, it wouldn't even be a safe withdrawal rate, it'd be just a withdrawal rate in that scenario. Because of this, a personalized allocation will almost always beat a general allocation. Say you're someone with a lot of pension income that only needs about $20,000 a year from their portfolio. Compare this to a retiree with the same portfolio size that needs $60,000 per year from their portfolio. These two retirees shouldn't have the same allocation because they have different needs. The latter retiree should probably have a bit more safety. To personalize allocations for our clients, we walk through a process of building out something we call a liquidity plan that involves mapping out 10 years worth of income need for a retiree. Depending on that client, we generally want 4 to 7 years worth of safety tranched out where we know if a market crash happens today, we don't need to take any stock withdrawals for that 4 to 7 year period. Effectively, we're going to match safety to what the client needs from an income standpoint, not just some general round number that is more or less chosen at random. Now, there are multiple ways to personalize out an allocation. I'm not saying you should use our method, but researchers have found that this one approach alone, on average, increases income capacity by nearly 10%. Then finally, an area where I see some of the biggest mistakes in investing comes in security selection. Say you're going to be a 60-40 portfolio. What exactly are you investing in to get to 60% stocks? What about 40% bonds? Let me give you some examples of why this is so important and talk about some of the common mistakes that we frequently see. So we already went through one example of this with choosing your cash allocation. Choosing your bond allocation is equally as important. First, there are questions of what kind of bonds you will invest in. Muni bonds, treasury bonds, corporate bonds, each have benefits but also drawbacks. What I see from a lot of retirees is a quick decision to invest in muni bonds because muni bonds are tax-free at the federal level. But we don't really care about whether we have to pay taxes or not when comparing given investments. We care about where we end up after taxes. Here's an example spread between a muni and a treasury bond. The muni bond offers lower nominal rates by about 1.2%. So what tax rate would we have to pay where they would prefer a tax-free muni bond over a taxable treasury bond? Well, if we're paying a federal tax rate over 31%, you should opt for the muni bond in this case. The problem I see is too many retirees never walk through this math. They simply just choose the muni bond because of the tax-free label. Another area I see a lot of poor management is in stock selection. Say we agree that in your asset allocation, it makes sense to allocate 50% of your equity portfolio to growth stocks and 50% to value stocks. Too often, I see investors take the fund or stock of the day and way over allocate to it. In 2021, ARK funds were all of the rage after a great year of performance. Technically, ARK funds would fit into the growth stock category, but it isn't at all the same as holding a more general growth stock index fund. The latter gives you far more diversification. I see the same thing with individual stock selection. Maybe a certain stock has done incredibly well, like Nvidia. Nvidia is classified as a growth stock, so why not allocate a big portion of our growth allocation to Nvidia? Well, remember that risk matters more than growth in retirement. Allocating to one growth stock versus a portfolio of growth stocks are different things. They will deliver significantly different results. Here's another example. When choosing between funds, way too many investors simply choose a holding based on what performed better over some recent period of time. The problem is there is a deeper context that needs to be factored in here. There's a certain fund managed by Barron Partners that makes this point very clearly. For some time now, this fund has held a massive holding in Tesla, and because of this has had some fantastic performance at the beginning of this decade. If you were sitting here in 2021 and comparing this fund to another growth fund just on performance, this fund would look like a clear winner. But that's because you're more or less holding one volatile stock that has had really good runs. Because of this, the performance of this fund will more or less center around the performance of Tesla in this case. This is the last thing you want. You're not buying into a fund to primarily hold one stock. You hold it for diversification. But even security selection matters for index investors. On the screen, I have a breakdown showing how different index providers classify large, mid, and small cap stocks. As you can see, there isn't one agreed upon classification. Well, why does this matter? Well, as you invest in index funds, if you're mixing and matching providers, you may have a lot of overlap. The S&P classifies certain companies as small cap, where Russell might classify those same companies as mid cap companies. So if we're mixing and matching funds based on these two indexes, we might be overlapping holdings and completely missing out on other areas of the market. This will likely have a smaller impact than some of the other security selection issues I've shown in this section, but nonetheless should be something that is reviewed before setting your allocation. Way too many investors think they have an incredibly diversified allocation, where in fact, they simply have 5 versions of the same flavor. I hope you enjoy this information-packed video. Early in this video, I talked about the idea of a reverse glide path for managing your allocation in retirement. This is a counterintuitive strategy, but it has some really interesting results and benefits for retirees. If you are wanting a more complete breakdown of what this strategy is and who it is best used by, click on this video right here where we give that more complete breakdown. Thanks for watching today's video, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.